Hi, Brandon Davis with Davis CPA. Today I'm going to talk about net income versus cash flow of a transaction and also of just business operations. Maybe asking me, well, aren't those the same thing? Well, sort of. Here's what we've got. So whenever a company is in business and we're generating revenue, so let's talk about our income statement. That's what I'll put up here. And we're looking at our income statement. We generate net income. And how we do that is we have sales. So let's say in this fact pattern we've got $100,000 of sales, okay? And we've got expenses, so let's call this sales. And we've got expenses down here. So let's say maybe we got utility expense, we've got wages, let's see, insurance, what have you. And so we've got our expenses down here. So maybe there's 10,000 in each one of those. I'm just gonna keep this simple for talking purposes. And so one might say, all right, so we got $30,000 in expenses against $70,000 or $100,000 in income. It's going to give us $70,000 in profit or net income. Okay, great. We made 70 grand. We're doing awesome. Well, maybe you are, maybe you're not. One of the things we got to think about is the type of accounting method we're using. So let's say, for example, in this fact pattern here, we're under the accrual basis of accounting, meaning I'll recognize my revenue when I send an invoice out. And I'm in the service industry and I have a lot of business type clients. And a lot of times I will send them an invoice and they'll have 30 days to pay me. And so in this statement here, let's think about this. Say this is May of 2019 is what we're dealing with. Let's say we got $100,000 that I've invoiced out. This is awesome, this is a great month. Well, now I get to June, okay? So now let's draw a line here. Now we're in June. June I don't do so good. So maybe I have $50,000 in invoices I send out. My expenses are about the same. So we got 10K, 10K, 10K again. And so this month, you know, I only made 20 grand. I'm still doing okay, right? I mean, I'm up to $80,000 in profits. Things are looking good, kind of chugging down the line here. Well, now I get to July and I can't make payroll. And you're like, what? Why can't you make payroll? You got $80,000 in profits. Well, here's why I can't make payroll. Because I got another statement over here. And so I'm going to erase this. We had it in our mind, we made 20 grand in June. So now I'm going to look at my balance sheet. Now I have another video we talk about the difference between the balance sheet and income statement. Well, this balance sheet, this 70 grand I made last month, it ain't sitting in the bank account. It's sitting in what's called accounts receivable. My clients owe me 70 grand. They haven't paid me. I made it. I earned it. I got expenses. I paid for those expenses out of my bank account. So my bank account balance is going down because I'm covering this because I'm not collecting the accounts receivable. So this is where you get in trouble, where you have a situation where you're showing profit. And let's say maybe we're at the end of June now. Again, remember in June we made another 20 grand. So that was what, $90,000? So I have $90,000 sitting in AR. I've not collected a single penny of this money. And so I'm trying to come up with the cash because so now maybe on my balance sheet, which again, as a quick refresher, if you haven't seen my other video, a balance sheet is a snapshot in time. It shows you your cash position, your other assets like accounts receivable, people owe you money, who you owe money to, and then down here you have an equity section. And so maybe my cash position is only 5 grand because every month I've been bleeding the cash reserves I had to cover these expenses to keep the business rolling. And so now I don't have any cash, but I'm showing lots of profits. That's where you get in trouble when you look at the standpoint of revenue that you're making and not managing your cash flow. Cash flow is the most important part of a business, in my opinion. It's the part that keeps the business alive. I'd rather make less money here and make sure my cash position is high. Now, here's something you could do. One of the things I tell my clients is if you're offering terms to your customers where you send them a bill and they've got 30 or 45 days to pay you, well, on these expenses, a lot of times you got 30 days to pay those, right? You get your utility bill on May 5th, it's not due usually till June 5th. And so you want to take advantage of those terms too and create what's called accounts payable, meaning the expense hits my books, it's part of the factors here, but it's not out of my cash yet. So if I said, okay, I've got 30 days to pay this $10,000 bill here, I'm going to sit in AR, well, I just increased my cash by 10 grand because I haven't paid it yet. The expenses over here still shows my 70 grand, but I just increased my cash by 15K. Oh, there's the 10K I needed to cover payroll. So that's where cash flow really becomes an integral part of managing a business. Understanding when to pay bills, when to send invoices. Now, other ways to speed this process up when you send your invoices out, maybe you reduce your terms. You drop it down to where you only give them 15 days to pay you. Maybe you give them an early pay discount. Say, hey man, you pay me in the first 5 or 10 days, you're gonna get a % or 2 off whatever I invoiced you. So there's tricks and tips that you can use to speed up this cash flow process, but also taking advantage of terms that you're offered is very critical to do also. Now, one other thing I want to look at relative to this is the cash flows of a particular transaction. So the other thing I was going to talk about is the cash flow of a transaction. So here we go. I'm going to say, I'll put a heading up here, I guess. Cash flow of a transaction. Because again, we're talking about, this whole video is about net income versus cash flow, earnings or gain versus cash flow. I guess you can kind of tie it into 2 different scenarios here. Let's look at a transaction where I have a piece of property. Let's say, for example, I've got a piece of land that I bought for $50,000. And let's say I improved this property. I invested $100,000 in improvements. So maybe it was land I bought, let's just say land, and I put a building on it. And then now my cost basis in this now is $150,000. That's my cost. Well, land and buildings, they usually go up in value, right? So let's say, for example, the fair market value of this particular piece of property, now I got $150,000 in it, is worth $200,000. Well, that's pretty cool. Well, if I just had paid cash for everything and had never borrowed money to do it, if I sold it for $200,000, I would get $200,000 in cash coming to me, but I'd only pay tax on $50,000. The difference between my cost basis, and we're ignoring any depreciation or things out there, all of you accountant wizards that might be throwing comments out there. So we're going to ignore depreciation. We got $50,000 in gain, if you will, that we pay tax on, as everybody talks about paying taxes. Well, let's say, for example, that we borrow money against this property. So, you know, we got a $150,000 piece of property. It's worth $200,000. Well, heck, I can get a bank to loan me the money. Let's say I had them loan me $180,000 on this property. So now they've loaned me more than I've got in it. Well, that's okay because it's worth $200,000, so they're cool with that. And maybe I use this money over here in another business and venture or investment or what have you. Well, so we have the same fact pattern show up. You know what, I've had this property for a while and someone's offered to maybe pay me $200,000 for it. I haven't paid the bank yet back, but that's okay. So I get the $200,000 now that I get, and I pay off my loan. And so now I still have $50,000 in the same gain, but my cash I received is only $20,000. And you may go, whoa, 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 I got to pay tax on 50, but I only got 20. Well, because that's the difference between the cash flow of a transaction and the gain-loss situation of a transaction. You know, I have clients that sometimes get a little frustrated with that because they'll have situations where maybe in our fact pattern, we've taken depreciation against this property, which means we would drop the balance of the value even further from a cost basis perspective. Maybe we took 50 grand in depreciation on this property. Well, now my basis, my adjusted basis would be 100K, my gain would be $100,000, but I only got $20,000 in taxes. Well, if I'm at a 20% effective tax rate, I barely got enough cash to pay off the debt, or I barely have enough cash to pay the taxes and I paid the debt off. So I got no money out of this thing I sold for $200,000. It's not a terrible thing, but it's something you got to think about. You got to always consider the cash flows of a transaction before you enter into it to say, well, what have I leveraged and why? Did it make sense at the time to do it? And will I have enough cash to cover the tax liability? That's why you always, when you go into a major transaction, you want to do some tax planning, projection work, and make sure you got all your bases covered. Another video from Davis CPA Group. Happy to help you with these things as they develop, and thank you for watching.